Hey everyone, welcome back to ForexCracked.com. If you're looking to up your trading game, understanding candlestick patterns is a crucial skill. Today, I'm breaking down the basics of how to read candlestick patterns so you can make smarter and more informed trading decisions. Let's dive right in. So what exactly are candlestick patterns? Candlestick patterns are visual representations of price movements in a given time frame, and they can give traders valuable insights into potential market reversals or continuations. Each candlestick has a body and wicks or shadows. The body represents the opening and closing prices, while the wicks represent the highest and lowest points reached during the time period. Let's break it down further. There are two types of candlesticks, bullish and bearish. Bullish candlestick, green or white. This shows that the closing price was higher than the opening price, indicating upward momentum. Bearish candlestick, red or black. This indicates that the closing price was lower than the opening price, showing downward momentum. These two basic candlestick types can form different patterns that traders use to predict future price movements. Now let's talk about some of the most common candlestick patterns. These are divided into two categories: reversal patterns and continuation patterns. Reversal patterns. Doji. A doji is a candlestick with nearly equal opening and closing prices. It signifies indecision in the market and can indicate a potential reversal. Hammer and hanging man. The hammer appears in a downtrend and signals a potential bullish reversal. Conversely, the hanging man appears in an uptrend and suggests a bearish reversal. Engulfing patterns, bullish and bearish. An engulfing pattern consists of a smaller candlestick followed by a larger candlestick that completely engulfs the previous one. A bullish engulfing pattern signals a reversal to the upside, while a bearish engulfing pattern indicates a reversal to the downside. Continuation patterns, rising and falling. Three methods. These patterns indicate a pause in the current trend, followed by a continuation in the same direction. Morning star and evening star. A morning star pattern typically forms at the bottom of a downtrend and signals a bullish reversal, while an evening star forms at the top of an uptrend and signals a bearish reversal. So how can you use these patterns in your trading strategy? Combine with other indicators. Candlestick patterns are powerful, but they should not be used in isolation. Combine them with other technical indicators like moving averages, RSI, or Fibonacci retracement levels for more accurate predictions. Identify key levels. Look for candlestick patterns at key support and resistance levels to confirm potential breakouts or reversals. Practice and backtest. The best way to get better at reading candlestick patterns is through practice. Use historical data to backtest and understand how these patterns play out. And there you have it, a basic introduction to reading candlestick patterns. Remember, like any other trading tool, these patterns are not foolproof but can be extremely helpful when combined with proper risk management and additional analysis. If you found this video helpful, don't forget to give it a thumbs up, subscribe to our channel for more trading tips, and hit that notification bell so you never miss an update. Thanks for watching, and happy trading!